Welcome to my finance channel. While the world obsessively watches tech stocks and interest rates, a profound silence masks a terrifying reality gathering in Wall Street shadows. We walk through a financial market that appears eerily calm, yet beneath this tranquil surface, the fundamental architecture of trust is quietly disintegrating. The smartest money is silently preparing for a storm that ordinary investors cannot even see approaching. Recently, a staggering bombshell shattered this illusion of peace. BlackRock, a colossal entity managing $11 trillion, faced sudden demands from investors to withdraw $1.2 billion. Shockingly, they only returned $600 million, keeping the rest firmly locked away. Blue Owl, another giant, completely welded its exit doors shut. A silent, suffocating panic is rapidly spreading across global finance. You must ask yourself a chilling question. What happens when the assets you trust the most cannot be sold or withdrawn? We are looking at a financial leviathan known as private credit, a market that has explosively swelled to $1.8 trillion. It operates entirely in the dark, promising exquisitely smooth returns away from the prying eyes of traditional banking regulators. Human greed is endlessly seduced by the promise of absolute safety mixed with high reward. For years, wealth managers sold these private credit funds as a flawless sanctuary. Because these assets do not trade publicly, their net value curves appear eerily straight. However, this artificial smoothness is not true stability. It is merely a delayed recognition of a decaying and toxic underlying reality. The first terrifying cracks in this trillion-dollar facade are already bleeding into the open. Consider a company built on high-interest used car loans for subprime borrowers. They packaged these extremely risky debts into securities, stamped them with a pristine AAA rating, and sold them as riskless investments. When the fraud finally detonated, the true worth dropped to a mere fraction. Simultaneously, a corporate giant collapsed after hiding a massive web of secret debt. Investors believed leverage was safely low, only to discover a suffocating burden approaching 20 times their equity. As Jamie Dimon darkly warned, when you see one cockroach, it usually means many more are lurking hidden in the walls. These isolated defaults merely expose a deeply embedded systemic infection. Why do so many intelligent people willingly march into such a transparent trap? We suffer from a fatal cognitive blind spot, confusing the absence of price fluctuation with the absence of risk. When economic tides shift and interest rates punish the indebted, that illusion of infinite liquidity rapidly evaporates. The comforting mirage of easy wealth instantly mutates into a claustrophobic trap where no one can escape. Fu, the greatest illusion of financial security collapses the moment ordinary investors discover the exits have been secretly welded shut. Chapter 2. The Birth of the Shadow Leviathan. To understand how this Leviathan was born, we must rewind the clock to the ashes of 2008. In the aftermath of that catastrophe, global regulators shackled traditional banks with ironclad rules. They forced them to hold massive reserves and avoid risky corporate lending. But the insatiable human thirst for capital never died. It simply migrated into the unregulated shadows. Nature abhors a vacuum, and so does Wall Street. A new breed of financial predators stepped in to fill the void left by cautious banks. These private credit funds operated freely without the suffocating chains of banking oversight. They willingly lent billions to mid-sized enterprises that traditional institutions had deemed far too dangerous to touch. The yields were astounding, and the profits were intoxicating. In the beginning, this murky pool was exclusively reserved for giant institutional titans like pension funds. These professional entities deeply understood the risks. They knew their capital would be strictly locked away for 10 years. However, Wall Street greed always demands infinite expansion. Approximately 5 years ago, These fund managers turned their hungry, predatory gaze toward a much softer target, the ordinary retail investor. How does an institution convince the middle class to buy illiquid, high-risk corporate debt? They craft an irresistible psychological trap. They offered a seductive combination that seemed to defy basic economic gravity. They promised annual returns exceeding 8 to 12%. At a time when traditional savings paid nothing, greed instantly blinded the retail herd to the underlying mechanics of the financial structure. The most fatal component of this pitch was the illusion of liquidity. Unlike traditional private equity that locked money away indefinitely, these retail products offered a comforting escape route. They promised a quarterly withdrawal window, allowing investors to take back 5% of their money. It sounded like the perfect harmony of high reward and absolute safety. But it was built on a frightening assumption. This beautiful promise relies entirely on the hope that everyone will never panic at once. It creates a classic, lethal duration mismatch. You cannot ethically fund a 5-year, highly illiquid corporate loan using money that theoretically demands an exit every 90 days. Unlike a traditional bank, these shadow lenders possess no central bank bailout guarantee and no government deposit insurance to save them. Human nature desperately yearns to believe in the magical free lunch. We continually crave the exhilarating returns of danger while childishly demanding the absolute security of cash. This cognitive dissonance allowed trillions of dollars to blindly flow into a black box. We ignored the fundamental law that when a yield is exceptionally high, the hidden price you pay is your eventual inability to escape. As long as the macroeconomic skies remained clear and sunshine poured down, the illusion held firm. But when the herd suddenly senses a shift in the wind, paralyzing fear takes control. When everyone rushes toward that tiny 5% exit door simultaneously, the architecture violently buckles. The comforting mirage of liquidity instantly transforms into a crushing, suffocating bottleneck of absolute despair. The promise of high yield and easy exits was nothing but a carefully engineered trap for the unsuspecting masses. Chapter 3: The Illusion of the Perfect Borrower. To comprehend the true magnitude of this approaching calamity, we must examine where this shadow money actually flowed. For over a decade, private credit managers obsessively hunted for the perfect corporate borrower. Surprisingly, they did not choose tangible industries like manufacturing or real estate. Instead, they poured hundreds of billions into a seemingly invincible sector, software as a service. Between 2015 and 2025, over 1,900 software entities were devoured by private equity. This frenzy was fueled by more than $440 billion in borrowed capital. Why did the predators love software? Because it promised the ultimate financial elixir: predictable subscription cash flows, high profit margins, and trapped customers. Financial models dictated that a customer entangled in a complex software ecosystem could never easily escape. Switching systems historically required crushing costs, endless retraining, and massive headaches. Therefore, Wall Street arrogantly assumed these tech companies would print cash forever. Nearly 1/3 of the entire private credit universe was staked on this single, exquisitely fragile assumption of eternal technological dominance. But history mercilessly punishes arrogance. The black swan did not arrive as a traditional economic recession. It arrived as artificial intelligence. Suddenly, a single intelligent agent could replicate the functions of a massively expensive software suite for a mere fraction of the cost. The foundational logic supporting hundreds of billions in corporate debt began to vaporize overnight in plain sight. The 3 pillars of the perfect borrower instantly crumbled. Migration costs disappeared when artificial intelligence could translate and transfer corporate data. In days, instead of months. High profit margins collapsed because competitors armed with algorithms no longer needed armies of expensive human developers. When the underlying business model decays, how can a corporate borrower possibly continue to pay its crushing debts? A terrifying new whisper echoes through trading floors, the software as a service Armageddon. Analysts at UBS issued chilling warnings that artificial intelligence is accelerating this destruction far faster than anyone modeled. Under these brutal conditions, they estimate that default rates in private credit could violently spike from under 3% to a catastrophic 13%. The bloodletting is mathematically inevitable. To conceal this horrifying reality, fund managers resorted to a desperate accounting illusion known as payment in kind. When a borrowing company cannot produce cash for its monthly interest, the fund simply adds that out interest back onto the principal debt. They pretend the loan is healthy while the hidden financial hole systematically deepens. It is a temporary bandage over a fatal wound. Now, the ultimate reckoning approaches. This year alone, a staggering $162 billion of these illusions face a brutal maturity wall. These companies must refinance their debts in a world of punishingly high interest rates while being eaten alive by technological obsolescence. This is why the smart money is frantically banging on the locked exit doors of Wall Street. While the ultimate technological revolution inadvertently detonated the most fragile corporate credit bubble in modern financial history. Chapter 4. The Three Gates of Despair. When the fundamental logic of an investment collapses, rationality instantly evaporates. The primal instinct for survival takes complete control, driving the herd toward the exits. But what happens when tens of thousands of panicking investors simultaneously discover the door is far too narrow? This month, three titans of Wall Street faced the exact same inferno, revealing three radically different methods of managing absolute despair. Consider the chilling decision made by Blue Owl. Facing a tsunami of redemption requests, they did not simply pause withdrawals. They permanently welded the exit doors shut. They declared that the quarterly liquidity window was eliminated forever. The capital would only be returned slowly, dictated by their own opaque timeline. The comforting illusion of access was violently replaced by the cold reality of financial imprisonment. The market punished this arrogance with merciless brutality. Their stock plunged for 11 consecutive days, erasing over 60% of its value. Investors voted with their feet, demonstrating a profound psychological truth: capital demands freedom. When a financial institution unilaterally confiscates your liquidity, it obliterates the sacred trust that holds the entire system together. The silent panic mutated into roaring outrage. Contrast this with Blackstone, managing an $82 billion flagship fund. Facing a record withdrawal demand equating to 7.9%, they chose a brain-tricking public relations gamble. They met every single request. To do this, 150 executives personally injected $150 million of their own wealth, contributing to a $400 million internal bailout. It was a desperate display of theater designed to project invincibility. By placing personal cash on the counter, they hoped to calm the terrified herd. However, this strategy harbors a fatal, structural flaw. Executives cannot personally subsidize withdrawals every single quarter. Furthermore, this creates a dangerous moral hazard. By rescuing everyone today, they have inadvertently trained investors to rush the exits tomorrow without fear of consequence. Finally, we must examine BlackRock, the ultimate leviathan controlling $11 trillion in global assets. When desperate investors begged to withdraw $1.2 billion from a newly acquired enterprise fund, BlackRock delivered a cold, mathematical rejection. They strictly enforced the 5% cap, handing back only $600 million and trapping the rest inside the failing architecture. The arrogance of their defense is truly breathtaking. Executives claimed that trapping investor capital allowed them to seize better market opportunities. Translated into honest language, this means your wealth is now hostage to their speculative gambles. The moment the world's largest asset manager unapologetically denies liquidity, a deep psychological contagion begins. The myth of the safe harbor is permanently destroyed. We must understand that liquidity is never a guaranteed mathematical certainty. It is a fragile psychological illusion. They promised you could always access your wealth right until the very second you actually needed it. The gates of Wall Street only remain open when everyone decides to stay inside. When fear takes root, the invisible hand of the free market quickly closes in to choke you. 4. Chapter Reflection. The ultimate cruelty of financial engineering is promising freedom while secretly constructing an inescapable prison. Chapter 5. The Invisible Web of Contagion. We often harbor the naive delusion that financial disasters only destroy those directly involved. The average citizen observes the private credit meltdown and feels entirely insulated, assuming their traditional bank account is safe. But modern finance possesses no borders. It is a highly charged, interconnected high-voltage grid where a single spark in the shadows easily ignites the entire structure. This $1.8 trillion beast does not exist in a vacuum. It is deeply intertwined with the traditional banking system, the broader stock market, and even the sacred pension funds holding your retirement savings. When shadow banking detonates, the resulting shockwave will inevitably crash into the real economy, freezing the very institutions you rely upon for daily survival. The guardians of the global economy are already quietly panicking. The Bank of England recently conducted an unprecedented stress test focused entirely on the private equity and credit markets. Central banks do not run these exhaustive drills for minor anomalies. Their internal warning systems are flashing a blinding red, acknowledging that this shadow leviathan represents a lethal threat to absolute global stability. Ratings agency Moody's issued a severe warning, projecting this opaque market could easily breach $2 trillion by 2026. The terrifying truth is that size does not equal safety. As the scale expands and the structural nesting deepens, the inevitable collapse becomes exponentially more destructive. A market this massive cannot fall without pulling the pillars of the global economy down with it. We no longer need to rely on theoretical models of disaster. The international ratings giant Fitch recently revealed that the trailing 12-month default rate in United States private credit has silently crept up to 5.8%. This is not an abstract projection. This is the reality of financial bleeding happening right now in the shadows, hidden from the daily headlines. Unlike a sudden stock market crash that forces you to scream in pain, this crisis resembles a slow, terminal disease. An enterprise cannot pay its principal, so they quietly request an extension. They cannot cover the cash interest, so they simply issue a white note to the lender. This chronic deterioration paralyzes human rationality, tricking us into believing everything remains perfectly fine. Our greatest psychological flaw is our absolute refusal to accept reality until the coffin is closed. As long as the sky has not visibly fallen and the news anchors have not officially declared a systemic meltdown, we comfort ourselves with the illusion of stability. We ignore the silent rot consuming the foundation, hoping the structural integrity will magically repair itself. Fruit Chapter Reflection. The most devastating financial plagues do not announce themselves with a roar, but slowly poison the water supply while the village sleeps. Chapter 6. The Collapse of Confidence. When the infection of systemic contagion reaches the surface, The absolute collapse of confidence is inevitable. We must observe the actions of the true masters of global wealth, those who have survived multiple historical crises. They do not wait for the official headlines to announce a financial meltdown. They systematically prepare for the worst while the rest of the market continues to sleepwalk into the abyss. Consider the unprecedented actions of legendary investors like Warren Buffett. He is not chasing these artificial high yields or scrambling for illiquid corporate debt. Instead, his conglomerate is hoarding a historic, record-breaking amount of pure cash, reaching hundreds of billions of dollars. He understands a fundamental truth. When asset prices are dangerously inflated and macroeconomic uncertainty peaks, holding cash is the ultimate investment strategy. True financial mastery is not about maximizing returns in a blind frenzy. It is about knowing exactly when to step away from the casino. The greatest titans like Jamie Dimon and Howard Marks are synchronizing their warnings. They are methodically tearing off the luxurious wrapping paper from these private credit products, exposing the decaying foundations underneath. They are preparing for the exact moment the illusion completely shatters. As the inevitable crisis approaches, ordinary investors must strip away their own delusions and ask 5 ruthless questions. First, exactly which specific company did my money go to and what actual business are they conducting? You must pierce the veil of the fund manager and see the ultimate borrower. Blind faith in a prestigious brand name is the fastest route to total financial annihilation. Second, if the macroeconomic environment rapidly deteriorates and high interest rates persist indefinitely, how will this borrower possibly repay the principal and the interest? Third, is the smooth, upward trending net value of your portfolio based on actual, hard cash transactions, or is it a complete fabrication engineered by an internal mathematical model? You must learn to differentiate between hard reality and institutional fantasy. Fourth, when panic strikes and you desperately need your capital, will it arrive instantly, or will the exits be violently locked, forcing you into an endless queue of despair? Finally, is this exceptionally high yield a true reflection of a thriving underlying business? Or is it simply the hidden price paid for using your financial lifeline to absorb catastrophic credit risks? If you cannot answer these 5 interrogations with absolute certainty, you are not investing. You are blindly gambling your own survival. The private credit market has spent a decade luring the unsuspecting middle class into a murky shadow world. The complete collapse of confidence begins the exact moment you realize the comforting promises of Wall Street were nothing but exquisitely packaged lies. For chapter reflection, the greatest wealth is not found in chasing blind yields, but in possessing the clarity to ask the hard questions before the exits are locked. Chapter 7, the reconstruction of order. When the dust settles on the private credit implosion, the financial landscape will be entirely unrecognizable. The ruins of collapsed software companies and bankrupt shadow lenders will litter Wall Street. However, capitalism never truly dies. It merely transfers wealth from the blindly optimistic to the ruthlessly prepared. The destruction of the old paradigm is simply the violent birth of the new order. Remember why apex predators like Warren Buffett hoard hundreds of billions in pure cash? They are patiently waiting for this exact moment of absolute despair. When panic forces private credit funds to liquidate their assets at catastrophic discounts, the smart money will swoop in to feast. Wealth does not evaporate during a crisis. It simply migrates toward those who refused to believe the illusion. The true tragedy inevitably falls upon the ordinary citizen. The middle-class investor who sought a safe harbor in shadow banking will become the unwitting sacrifice. Their retirement savings and hard-earned capital will be erased to balance the systemic equation. This is the cruel, eternal law of financial markets. The ignorant constantly subsidize the brilliant through exquisitely packaged deception. Once the toxins are violently purged and the bad debts are eradicated, a new cycle of trust will hesitantly begin. Regulators will emerge from the shadows, promising that this level of shadow banking chaos will never happen again. New ironclad rules will be drafted, and the market will slowly regain its equilibrium. But human greed is an indestructible force of nature that always mutates. A decade from now, a new financial instrument will inevitably emerge, wearing an entirely different but equally beautiful mask. It will promise flawless yields and absolute safety, exploiting the very same cognitive vulnerabilities of a completely new generation. The architecture will look different, but the underlying betrayal will remain identical. History in financial markets does not merely repeat itself, it echoes with increasing brutality. You must elevate your financial cognition to survive the coming era. If this deep dive into the abyss of private credit shattered your comforting illusions, please like this video and subscribe to my channel. We will continue to expose the hidden truths masked by Wall Street propaganda. True protection comes from ruthless interrogation of the system, not blind faith in its promises. I leave you with one final, haunting question to ponder as you analyze your own investment portfolio tonight. If the wealthiest and most powerful financial institutions on earth cannot accurately predict when the emergency exits will violently lock shut, how can you possibly believe you will have the time to escape? Full chapter reflection. The ultimate secret of financial history is that every catastrophic collapse is merely a violent wealth transfer disguised as an accident. Chapter 8. The ultimate philosophical warning. As we stand on the precipice of this $1.8 trillion abyss, we must ask ourselves a profound philosophical question. Why does humanity continuously build these magnificent towers of debt, knowing they will inevitably collapse? The answer lies deeply embedded in our collective psychology. We are terrified of stagnation, always preferring the beautiful illusion of perpetual growth over the harsh reality of finite resources. The private credit leviathan is not an anomaly. It is merely the latest manifestation of our eternal greed. Every generation believes they have finally conquered risk, engineering complex mathematical models to banish volatility forever. Yet risk can never be destroyed. It is only hidden, compressed, and transferred. By masking the daily fluctuations, Wall Street merely allowed the systemic poison to accumulate in absolute silence. Consider the tragic fate of the ordinary investor in this grand financial theater. They do not desire to be greedy speculators. They merely seek a safe harbor to protect their lifelong labor from the eroding winds of inflation. But the system is designed to exploit this exact desire. The architects of Wall Street weaponize the middle class search for safety, feeding them toxic assets wrapped in golden paper. When the systemic contagion finally erupts, the true hierarchy of power reveals itself. The apex predators, holding hundreds of billions in cash, will easily survive and multiply their fortunes. They will feast upon the distressed assets, purchasing the ruins of the software industry for pennies. Meanwhile, the retail investors, locked behind the welded doors of their shadow funds, will watch their wealth silently evaporate into the void. This is the cold, unforgiving reality of the global financial machine. It does not exist to democratize wealth. It exists to harvest it. The transition from liquidity to illusion is complete. The private credit market demonstrates that when trust is fully monetized, it becomes the most dangerous weapon on earth. We have voluntarily surrendered our financial autonomy to a shadow system that operates entirely without a safety net. As we conclude this immersive journey into the dark heart of finance, I urge you to awaken from the collective sleepwalk. Do not blindly trust the pristine charts or comforting promises. True enlightenment requires a relentless skepticism of anything that appears too perfect. Protect your capital, question the mechanics, and always remember, in the world of Wall Street, if you cannot see the risk, you are the risk. Chapter Reflection. The greatest financial tragedy is not the inevitable collapse of the system, but humanity's endless willingness to rebuild the same illusion. Chapter 9. The invisible web and the sacrifice of the ordinary. Many people hold a naive illusion that avoiding high-yield products ensures their survival in this financial storm. However, the modern financial system is an electrified high-voltage grid. Absolutely no one can truly escape its reach. Even if you have never heard of private credit, your personal wealth has likely already been quietly placed upon Wall Street's high-stakes gambling table. Please ask yourself a haunting question. Where did your hard-earned pension contributions and long-term life insurance premiums eventually flow? During the past 10 years of extremely low interest rates, traditional treasury bonds could not meet the massive needs of pension funds. To desperately fill this deficit, these supposedly conservative institutions poured trillions of dollars into the murky abyss of private credit. This terrifying reality means the true creditors behind those high-risk used car loans packaged as AAA securities are ordinary citizens. The debt supporting those obsolete software companies is secretly financed by millions of people, eagerly hoping for a peaceful retirement. You foolishly believed your future was safely locked inside an impenetrable vault, but it is actually being weaponized to support crumbling corporate leverage and Wall Street greed. When the liquidity doors of private credit are completely welded shut and massive fund managers announce suspensions of withdrawals, the true systemic dominoes finally begin to fall. The International Monetary Fund long ago issued severe warnings that the fatal flaw of private credit is maturity mismatch. This shadow banking detonation will mercilessly spread, crippling traditional stock markets and directly freezing your sacred pension funds without a single warning. We are witnessing an exquisitely camouflaged game of wealth transfer. Financial elites happily extract enormous management fees and immediate profits during the climax of the illusion. Yet, when the feast violently ends and leaves a trail of absolute ruin, the ultimate cost is always borne by the ignorant public. The system survives entirely by carefully disguising its most lethal bombs as the safest financial havens imaginable. Humanity must violently awaken from this collective economic sleepwalk. When you examine your own asset allocation tomorrow, do not simply accept a smooth, upward trending yield curve. You must bravely pierce through the luxurious packaging and ruthlessly interrogate the underlying credit logic. In an era dominated by financial illusions, blindly trusting the architects of Wall Street is the absolute fastest path toward your own irreversible financial destruction. Fourth chapter reflection. The greatest cruelty of the financial grid is that your future was secretly gambled away, even while you refuse to play the game. Chapter 10. The end of the illusion and the great reset. Every great financial cycle ends not with a bang, but with a silent locking of doors. The private credit market, now swollen to $1.8 trillion, has reached its absolute limits. We are witnessing the twilight of an era where free money and blind trust fueled the greatest accumulation of shadow debt in modern history. The illusion of infinite liquidity is finally evaporating before our eyes. We must understand that financial history operates in brutal, unforgiving rhythms. In 2008, the world was brought to its knees by subprime mortgages disguised as pristine bonds. Today, we face the exact same psychological trap, simply wearing a different mask. We have replaced the overvalued suburban houses with obsolete software companies, and we have replaced naive home buyers with desperate pension funds. Why do we continually repeat these catastrophic mistakes? because human greed always overpowers historical memory. When interest rates were punishingly low, investors begged for yield, willingly surrendering their rationality to Wall Street magicians. We convinced ourselves that high returns could magically coexist with absolute safety. This cognitive dissonance allowed a shadow leviathan to grow unchecked, feeding directly on our collective desire for a financial free lunch. As the crisis deepens, the true masters of capital will methodically execute their final play. While the ordinary middle class remains trapped behind welded exit doors, begging for fractions of their savings, the apex predators will use their mountains of pure cash to harvest the wreckage. They will buy distressed assets for pennies, rebuilding empires on the graves of retail investors. This is the cruel biology of capitalism. You must immediately stop playing the victim in this grand financial theater. The era of passive investing is dead. If you cannot explain exactly how your yield is generated, you must assume you are the yield. We must cultivate a relentless, cold skepticism toward any financial product that promises stability without transparency. Survival demands that we adopt the ruthless clarity of those who orchestrate the game. The storm will not arrive tomorrow. It is already raging in the shadows. The defaults are rising, the exits are closing, and the fake net values are trembling. Do not wait for the mainstream headlines to declare a systemic meltdown before you take action. By the time the panic reaches the evening news, the opportunity to protect your wealth will have permanently vanished. This brings our immersive journey into the shadow banking system to a close. If this exploration shattered your illusions and upgraded your financial cognition, please like this video and share your philosophical reflections in the comments. Remember to subscribe to the channel so we can continue deciphering the hidden mechanisms controlling our global wealth. Together, we will navigate the approaching turbulence with open eyes. As we turn our backs on the splintering facade of private credit, I leave you with one final chilling question to keep you awake tonight. If the most sophisticated institutions on earth are secretly bolting the doors and trapping your lifelong savings inside a burning building, then what exactly do you think is left inside the vault when the smoke finally clears? Through chapter reflection. The ultimate financial liberation begins the moment you realize every crisis is simply a massive wealth transfer waiting to happen. Chapter 11. The Epilogue and the Awakening. Welcome to the final chapter of our journey. The storm we have discussed is no longer a distant warning. It is a present reality. As the private credit leviathan struggles under the weight of $1.8 trillion, the ordinary investor must make a critical choice. You can either remain paralyzed by fear, or you can use this knowledge to radically reconstruct your financial philosophy. True wealth is never destroyed in a crisis. It is merely transferred from the blind to the observant. We must abandon the childish illusion that Wall Street exists to protect our future. The machinery of global finance is designed to harvest the capital of the unsuspecting masses. To survive, you must decouple your mind from the herd mentality that worships smooth yields and blindly trusts authority. The most powerful asset you can possess in this turbulent era is not a high-yielding debt instrument, but absolute liquidity. There is a profound reason why the greatest investors on earth are currently sitting on mountains of pure cash. Cash is the ultimate option. It is the freedom to walk away when the casino doors lock and the power to buy when the ashes settle. We must learn to embrace market volatility as a measure of honesty. Traditional public markets may crash and burn, but they tell you the brutal truth every single second. Private credit, conversely, smiles at you with fabricated net values until the very moment it confiscates your wealth. Do not trade the pain of honest price discovery for the lethal comfort of an institutional lie. You must interrogate every investment with the ruthlessness of an apex predator. Ask yourself constantly, who is actually holding the risk? If a fund promises returns far above the sovereign rate, understand that you are writing an unpaid insurance policy for their ultimate default. In the shadows of high finance, if you do not know exactly who the victim is always you. As the foundations of the shadow banking empire tremble, remember that human civilization always endures. The cracks in the credit system will eventually heal, giving birth to new cycles of innovation and capital formation. But the scars left on the ignorant will be permanent. By upgrading your financial cognition today, you guarantee that you will be an architect of the new order, rather than collateral damage. Thank you for enduring this deep exploration of the private credit abyss. It requires immense fortitude to stare directly into the flaws of the system dictating our lives. Please like, subscribe, and share this knowledge with those still asleep. The greatest investment you can ever make is the courage to see the world exactly as it is, rather than how you wish it to be. The ultimate financial freedom is achieved the moment you stop relying on the system's beautiful illusions and begin trusting your own awakened cognition.